reason why I was so attracted to short sales was because, first of all, not many people wanted to do it. There was less competition, but you got so much bang for your buck, like I said, because you can generate tons of money. And the best I ever had, I had a couple times where I did six-figure discounts in the bank. So let's say that I get $20,000 a month combined from all my doors. That money comes into the trust as passive income, as rental income. Therefore, that is not going to be a taxable event of this trust.
Hi, everybody. Jose Luis Morales here. Welcome back to another episode of the Morales Group Show. Today, we have a very special guest. His name is Don Thornton. He is a real estate investor, and today he's going to be talking to us about a Spendthrift Trust, or the long name, non-grantor, irrevocable, complex, discretionary Spendthrift Trust. And I said it all the first time. So welcome to the show, Don. How are you?
I'm doing fantastic. I really appreciate you having me on.
Of course, same here. So I'm excited about this episode, and the reason is that I found you on social media. Anytime I hear about ways to save clients money, provide additional asset protection, it gets me super excited. So for our viewers that don't know who you are, who is Don, and then how did you get involved in real estate investing? And then specifically, how did you learn about the Spendthrift Trust?
Sure. Well, I am known as your tax savings best friend because most of us overpay in their taxes.
Mm-hmm.
And I work with professionals whose sole purpose is to help people, not pay taxes that they don't have to. So that's what I'm doing now. And I came to this because I have made a lot of money in real estate. And I was also writing a lot of big checks to the IRS every year, and I didn't like it. I mean, as far as my background, I came into real estate completely unexpectedly. My whole career path was I was going to be in the State Department. I was going to be a diplomat. I was a Russian major in college. I went over to the embassy and worked for 2 years on a contract so I could be in the country. This is during the Soviet Union, and to have ability to speak Russian, to learn to speak with Russians and attain fluency in my language. Well, little did I know that the whole Soviet Union would fall apart, and then there was all this business that came in, and I got hijacked by the sweet smell of money. And I was 22, 23 years old, making $10,000, $15,000 a month in a country at the time where if you had $1,000 a month, you could live like a king, much less, 10 to 15,000.
15.
Yeah, I mean, it was just a dream, and I said, I'm not going to go back and be a diplomat. Screw that. I'm going for the money. So I spent the next, 15, 20 years. About 15 years I was over there. Got married, got kids. We had apartments. All we were doing. My mother-in-law and I were actually doing real estate investing in Russia. We were flipping apartments in Russia at the time. But eventually, all good things come to an end, and we just got to the point where I couldn't work there anymore. There was just no more opportunity for Americans. The real estate market was just too mafia-ish. I mean, you're every time you do a deal, you wonder if you're going to get met with by hitmen at your apartment building and put a gun to your head and shoot. So it was like, you know what, this is getting a little too mafia-esque for me. So I went back. I went to Orlando, and I needed to have a way to make money. And I knew I'd been spoiled already. I was never going to work for anybody again. And I was also spoiled by a certain level of income that I did not want to get used to living less. So I said, well, what's it going to be? I said, it's got to be real estate. So I spent 2 years trying to find what worked for me. And one day, I was doing mortgages and retail real estate just to keep the bills paid. I left my family in Russia. I came here by myself and said, when I got everything set up, you can come back here. So anyway, I heard about this. My mortgage partner said, why don't you go to St. Pete? There's this seminar going on. This guy does short sales. So what the hell is a short sale? He goes, well, no, you can someone who owes more than the property's worth. Nobody wants it. You can get the homeowner to work with you, and you can negotiate with the bank, and then you can create profit I said, you're telling me that I don't have to risk a dime, I don't have to rehab, I don't have to do anything, and I can make tens of thousands of dollars in profit? He said, yeah. I said, I'm there. So I went to it, I don't like courses. I don't like seminars. I always feel like I could probably figure it out myself. And so I just raised my hand up and said, look, I don't have the money for your course. What would you suggest I do? And he said, look up the foreclosures in your county and just go knock on their doors and say, I see you're in foreclosure. I would like for you to buy, I'd like for you to give me your house. I said, give you? He said, yes. Because that way you'll know if they're upside down. Because they're upside down, they'll say, yeah, take it. I don't want it. And the very first door I knocked on, and he told me, he said, if you knock on their doors, that was the thing. This was in 2003. So, and I said, okay, let's do it. And the very first door I knocked on, I got a house. And so it took me about 9 to 10 months for me to really get it. And then the hardest part was the negotiation part. But I learned how to do that just by trial and error. And then by the end of 2003, I was almost running out of money. I was really getting a little tight. And then I said, okay, something's got to hit real soon. And so in February 17th of 2004, I got my first short sale. I made $13,072.83. I still remember that. A week later, I made $25,000. 2 weeks later, I made $40,000. So I made close to $1 million from February 17th to December 31st. And so I was off and running. And I just realized this is my deal.
That's
And
awesome. So,
yeah, it was great.
so then you obviously started earning a lot of money doing
Mhm.
short sales, and maybe we
Yes.
can do another episode on that because I love for anybody that's been in the real estate market for less than maybe like 8 years, they're
Mhm.
not really familiar with
No.
the big short sale market. I'm lucky that I was familiar with it because I got into it in 2010 and I
Mhm.
got to see that, but I love to have an episode on that. But what I was going to ask you, you started making money. And then I imagine that the next step was, because it happened to me as well too. There was one year where I paid like what I felt was a lot of money at that time, and I was like, man, I'm tired of this. Like, I gotta
Mhm.
figure out ways to pay less money.
Right.
So how did you how did you learn about the Spendthrift Trust, and what is it, and and who does it help?
I learned about it by sheer chance. Okay. A couple years ago, um, a wholesaler had approached me and he wanted to work with me with short sales. And so we had a great communication. I thought it was great. And, I thought, okay, he's going to send me a bunch of deals. And then he disappeared. And so he came back to me and said, hey, I said, yeah, what happened to you? Where'd you go? He goes, no, man, I got something better. I said, better than short sales? He goes, yeah. He says, come to dinner. Come to Thanksgiving dinner, and I'll tell you all about it. I said, I don't want to go to Thanksgiving. I mean, I just said, whatever. And he says, look, I'll make prime rib for you. I said, okay, I'll go. I stayed there like 8 hours, and he told me all about it. And I thought to myself, this is fascinating. The reason why I was so attracted to short sales was because, first of all, not many people wanted to do it. There was less competition, but you got so much bang for your buck, like I said, because you can generate tons of money. And the best I ever had, I had a couple times where I did six-figure discounts from the bank. So it was like, wow, I can make so much more money so much more easily with short sales than I can flipping or doing the Burr method or whatever. So
Mhm.
I had the same, like, I got it. When he explained the strategy, I said, I got it. I said, I got to have this. I got to have this trust. So that's how I learned about it. And then, it's been amazing ever since I've had it. Amazing.
So let's assume that somebody doesn't know what the trust does or who
Okay.
does it help. So let's just backtrack. If I don't know
Sure.
what the Spendthrift Trust is, what is it? Who does
Okay.
it help? How does it work?
All right. Well, the official name of it is called a non-grantor, irrevocable, complex, discretionary spendthrift trust. I'm not going to go into that right now, but every single word has a specific role in allowing the trust to be compliant with a certain part of the U.S. tax code that allows major tax reductions to happen. Okay. So I'm just going to talk to you right now about who this benefits. There's four main benefits for this trust. The first one is any passive income that comes into the trust is not a taxable event for this trust. Okay? So what does that mean? If I'm a real estate investor and I own a multifamily, and I would say I have 40 doors, that means that if the trust owns that building, if I'm an investor and I sell it to the trust, I'm the trustee, so I still control everything. So that all my tenants are now paying me rent, paying my trust rent. So let's say that I get $20,000 a month combined from all my doors. That money comes into the trust as passive income, as rental income. Therefore, that is not going to be a taxable event for this trust. Number one. Commercial realty, any leases that come in, lease income is also passive income. Royalties, book royalties, film royalties, song royalties, anything that has to do with royalties, oil and gas, things like that. Royalties are also passive income, not taxable income for this trust. And then limited partnership profit sharing, that's also not a taxable event. So imagine now, investment income. If you have a Charles Schwab account, Fidelity, you got stocks and bonds, you have anything, you have passive investments, that money comes back into the trust, again, not taxable. So you can imagine who out there fits those descriptions of who, so that right there, those people could benefit from this trust. The second big advantage we have from a tax point of view is that when you have an asset that is inside the trust owns it. Apartment building, rental property, it could be cryptocurrency, it could be whatever, anything of value that when you sell it would trigger a capital gains tax event. If the trust sells it, that money comes back into the trust. It is not a capital gains tax event. So you don't have to do a 1031 exchange. You don't have to do a deferred sales trust. You don't have to do a Delaware statutory trust. You don't have to take accelerated depreciation, for real estate, right? You don't have to move to Puerto Rico for 6 months out of the year. You don't have to drop everything into an opportunity zone. You don't have to do any of that because all those have to do with deferring the capital gains. This one is not deferred. It's just not a taxable event. So and then then the third benefit is the trust can work with a business, an LLC, an S corp, and by working together, the businesses can move a substantial amount of their taxable income over to the trust as expenses. Okay, I'll get into that a little bit later, but all we're doing, the trust can add 2 additional expenses that the companies pay, and by doing so, large amounts of their taxable income can be paid to the trust and as passive income, and so they can substantially reduce their taxes that way. And then finally, because it is a spendthrift trust, that means that any assets that are sold into the trust are locked down as tight as you can get in this country. I'll give you a couple examples. Most property owners live in fear of the government coming knock on their door and saying, we're going to build a road through your front yard, so you're going to have to take our price or we're going to sue you for eminent domain, you're going to lose everything. And so people just buckle under. If your house and your land is inside this trust as a trust asset, they can't do anything. They cannot force you to move. That's number one. Number two, I'm sure a lot of you people have heard about this wonderful gentleman called O.J. Simpson. And, he had, the Goldmans filed a civil lawsuit against him, and got a wrongful death judgment against him for $34 million. We're like 20 plus years since then. But OJ had the foresight or had good advice to sell all of his assets into a trust with a spendthrift provision before the civil suit was instituted or was not instigated, but was started. And then they haven't cracked his trust yet. So that just gives you an idea of what. So those are the 4 biggest benefits this trust gives you.
Okay. And then, w- are you able to use the income like to live in it? So, like, let's say that I sell a property and I
Mhm.
don't want to reinvest. So, I don't want to do a 1031 exchange. I just want to cash out. I have the option of obviously cashing out on my investment, paying the capital gains. That way I can use the money. Can I still use the money to live, or how does that portion of it work?
All right. So the trust is not like a corporation or an LLC in the sense that you have more leeway as far as what is a trust expense as opposed to what a write off is. Okay. So first of all, any asset that you sell into the trust, whether that be personal or business, the trust is now obligated to maintain and pay for those assets. So if I sell a car into the trust, that means the trust, as trustee, gas. I'm paying for the gas. I'm paying for if you go to AutoZone to change out a filter. If it needs to get oil change, go to Jiffy Lube. Everything's paid for. Okay. So the house, if I our primary residence, that's now a trust asset. That means the trust pays for everything. The mortgage, the insurance. If you're at landscaping, plumber comes and does something. Whatever it has to do with that asset, the trust pays for that. So that alone relieves you from having to pay as much money as you would for expenses that are normally considered personal because now they're a trust expense, not yours. So I know that when I started doing this, I was able to significantly lower the salary I was paying myself from my S corp because so much of what I was using my salary for to pay for our personal expenses for the assets that we had are now on the trust. So the trust pays those. Okay. So for minor children, for example, trust pays for everything: food, clothes, education. The trust, those are trust expenses. Okay. Anybody in above 18, anyone who's still getting some kind of education, the trust still pays for those. So I have a son who's 22 years old. He's in university. So he was in a private school before that. My daughter was in a private school. Now, but she graduated before we got the trust. So my son. So he was in a private school. So the trust paid for his tuition. Now, understand how this works. The trust is not paying me the money for me to pay the university. The trust is directly paying the university the tuition. Okay. My son has a car. I did not give the trust did not give him money to buy the car. That would be a taxable event for him. The trust bought the car. The trust owns the car. The trust pays for everything that has to do with the car, but he's allowed to drive it as a beneficiary. So I don't give him a stipend to go buy food at university. The trust buys a food plan with the university and he gets his food there. You see what I'm saying?
Yeah.
So
So
we're not. I'm sorry. Go ahead.
it's almost like a way to take certain personal expenses, things that would normally be personal
Mhm.
expenses,
Yes.
and basically instead of you paying them personally, have the trust pay them,
Yes.
which makes it so that
Mhm.
you can basically pay yourself less money that
Yes.
would you would normally not be able to write off, basically, because
Exactly.
like if you're using the car for personal purposes, you wouldn't be able to, unless it's for a business, you likely wouldn't be able to write it off.
Right.
So okay.
Yeah.
And then uh-huh.
No, I'm just going to say. I mean, you if you have a beneficiary who is physically, mentally challenged in some way, disabled, then the trust pays for everything for them for their entire life. It's trust expense. Now, when you're an adult, it's a little bit different. I mean, there's it can pay for, like I told you, as far as showing how with the assets and what it can pay for assets wise and so forth. But it can't pay for food for you. Can't pay for what we call fashion. You know, I'll give you an example. So I was invited this weekend to go film an infomercial about the trust in my trust business. So I went. It was here in Florida, St. Pete. So I bought some clothes for that. because we did different shoots and they wanted to have different things. So I bought some clothes for that. The trust paid for that because that has to do with the trust business. If I had said, if my wife said, honey, you need some new clothes, and we go down to Macy's or Dillard's or wherever, Neiman Marcus, and we buy clothes, that is not a trust expense. Okay. So when I was in St. Pete, it's just like with the company, right? We went out after the infomercial, took them all out to dinner, had a great time, went out to a club afterwards. Trust paid for all that because it had to do with my trust event. Now, if I had done that with just my boys, not a trust expense. So you see how that works? And also fun. Okay, so if I just I'm going to be flying to Italy this year. I'm probably going to spend a month there. I'm going to rent an apartment and stay there and just have some fun. That is not a trust expense. Okay, so that's going to be paid for me personally.
So are there like general rules of thumb? Like, so anything that, are there rules of thumb as to what is considered an expense and what isn't considered an expense? Like if it's used for X, then it's considered an expense.
Use 4 F's. Okay. Food, fashion, fun, and facelift. Oh, by the way, medical is also a trust expense. I forgot to say that. Health and medical wellness, that's all trust expense. So we already talked about food, fashion, and fun a little bit, with the vacation and clothes.
Those are not considered trust expenses.
Those are not trust expenses. No.
Okay.
So facelift too. Elective surgery is not going to be covered. It's not a trust expense, but but the trust pays for insurance, pays for if anything happens health-wise, trust pays for it. So that any like acupuncture, any kind of medical procedures, it could be non-traditional or not, those are trust expenses.
Okay.
So it covers a lot.
So what's the negative with the trust? Because I mean, obviously, I'm listening to all this, and it all sounds like great. Is there any downfalls to this?
There can be, in the sense it's just been what your agenda is. You see, we got into this late in the day. For me, I'm 59 years old. We've got everything we want. I don't care about credit, for example. We buy things for cash. So I don't need to show a lot of money personally. Now, I haven't paid taxes the last couple of years either, so that's great, right? Because officially, I made very little money on my tax return because most of the trust is paid for almost everything, and I live very frugally, as far as officially goes. But if I had done this 15 years earlier, 20 years earlier, then I would not have wanted to do that because I still wanted to be able to qualify for loans and get credit lines and so on and so forth. So I would not have been able to take advantage of everything the trust offers because I need to show more income and have more things in my name. So at least initially when I got the financing for them. So if that's important for you, then you're not going to be able to get as much, so that you're not going to get as big of a chunk of the tax advantage from you personally, because you're going to be paid a W-2 salary, and of course we know you're paying taxes on that, right? So however much you want to show is how much you're going to pay taxes on as a salary.
So you wouldn't be able to get an equity line of credit, basically, because the assets are owned by the trust, in other words.
No, listen. You can get financing on an asset if the asset can offer collateral. Sure, you can do that. And if you don't pay your bill, you don't pay your payment, they can foreclose it if it's used as a collateral for a loan. Mm-hmm. But the difference is that they can't penetrate the trust to get to other assets. They can go after that particular asset, but that's it. Okay.
So it's almost like having individual LLCs for each property because they can't go after the other ones.
Right, but the only difference is that any attorney worth his or her salt can crack most LLCs eventually. They want to, whereas they're not going to crack this one.
So originally you said that each word in the actual name had
Hmm.
some sort of meaning, like the non-grantor, and then
Yeah,
the irrevocable complex, and then discretionary. Can you break that down a little bit? And that's just,
sure, absolutely.
yeah, okay,
So it's a non-grantor trust, which means that you, as trustee, are not the grant. You're not the one opening the trust up. If you
okay,
did, the IRS would consider this to be a grantor trust, which is basically alter ego between you and the trust. They would see no difference to it. So there'd be no tax advantages from that point of view. So the way we do this is that somebody else that you choose actually officially creates the trust. They use that person's social security number to get the trust EIN number, and then after that they make you the initial trustee, and then they resign. Okay, so then they're not involved in this anymore. You're the trustee. You have all the power. So that's one thing. It has to be a non-grantor trust. That's how we do this. Secondly, it is an irrevocable trust, and that does not mean that the trust can never be altered or they can't be. You can't make changes. People tend to have that erroneous belief about that. It's not true. All it means is that you can't transfer assets into the trust. It means they must be sold and the sale must be final. So when I sell my car to the trust owns it. The trust is going to be on title. I no longer own it. That's why it's irrevocable. Okay. Now we sell that at a price what you paid for it. It's called a cost basis because we don't want to trigger a capital gains tax event by selling our assets to the trust for a profit. So that's how we do that. It's a complex trust. It's a non-grantor irrevocable complex trust. That means that the trust governing instrument, the trust itself, does not require the trust to distribute any money to the beneficiaries. It doesn't say you can, it doesn't say you can't, it just is not required to. And that's very important because most trusts, especially simple trusts, like a revocable family trust, for example, or living trust, those are called simple trusts, which means that if there is any income, it's going to go. It's not going to stay in the trust. It's going to always flow down to the beneficiaries. Okay, it's designed to be kind of a pass-through situation. This trust is not. The money is allocated to the corpus of the trust, to the trust itself. So the money comes in the trust bank account. It stays there. Now, listen, if going back to my son, if I wanted to, if he said, "Pop, listen, I need $20,000 and I don't want to tell you why." And I said, "Well, just the trust can pay for it." "No, I don't want that. I want it." It's okay, fine. So I cut him a check. The trust cuts him a check for $20,000. The trust does not pay taxes on that, but he will. That's a taxable event for him. So most important thing to understand here is that the trust is not required to distribute to beneficiaries. It is a discretionary trust. That means that the trustee has 100% discretion or power in the trust to do whatever needs to be done to add beneficiaries, remove beneficiaries, make all decisions for the trust. And that's important. And I'll get into that in a second. But the final one is it's a spendthrift trust. And that's where the asset protection comes in. That's when I spoke previously about O.J. Simpson, about eminent domain, because that provision means that unless they can prove that you have done criminal activity or you illegally sold your assets into the trust to avoid a lawsuit, which is called fraudulent conveyance, then it cannot be sued. I mean, it can be sued, but it's not going to go anywhere. The judge will toss it immediately once it comes to his attention that whatever asset they're going after is in a spendthrift trust. So that's what this means.
and then you talked a little bit about the sale of the property into the trust, and you talked a little bit about selling it at a cost basis. Can you go over what that process looks like of
Sure,
selling items into the trust?
sure. Okay. So we have about 9 investment properties that we sold into our trust. What that meant is we did a bill of sale. So we had a bill of sale for every single thing. Made a list of all the assets we were selling, and we put in how much do we pay for it when we bought it. Number one. If it's real estate, we added 25% to that for household furnishings, fixtures, whatever. Okay, so we add 25% to that. Then if it's an investment property, if we had, first of all, any improvements we may have made. Okay, if we put money into it, that's also added to the price. Now, if it's a real property where we took depreciation on our tax returns, then we would subtract that depreciation amount. Whatever that is, that's the number. So that number goes on the bill of sale. Our crypto, whatever price we bought it at, right there. That's it. We're selling everything. So the bill of sale, it's a private document. Nobody sees it. It's in my trust book, but it lists every single thing that we sold into the trust. At the bottom of the form, it says this is the total amount that the trust, is buying from us, basically. Okay, because it's a sale, so there has to be some kind of contribution, right? So the difference is, now that we have a bill of sale, if there's any real estate, then the deed has to go with that. So bill of sale plus a deed if a deed is required. So once that is done, in our case it was like 2.8 million, something like that, then the trust owes us that money. So we don't want the trust to pay us right now, but we can draw upon that whenever we want to, because the trust is going to give us what they call a demand note, or it's like an IOU, right? So if, for example, I need that, so let's go back to my son. If I said personally, I'm going to give him that $10,000 or $20,000, well, I could take it out of my taxable income. If I was getting a salary, I could do that. Or what I could do is I say, okay, the trust owes me $2.8 million. I'm going to have the trust cut me a check for $20,000. I'm going to give that to my son. That $20,000 is not a taxable event for me because it's just a return of capital. I'm just getting back what I paid for it. I mean, there was no profit in that transaction. Okay.
Mm-hmm.
So now, as I run my life and we do our taxes and so forth, I buy everything. Every dime I spend is with my trust debit card. So I have a QuickBooks account, just like I have for my S corp, and I have, in QuickBooks you have columns of what you attribute every single transaction towards. Is it an expense? Is it a debit? Is it a credit? What was it for? And so on and so forth. So even if I pay with my debit card for something that's not a trust expense, I don't care, because when I submit my stuff to my accountant, if he sees that something, if I paid for like a vacation and it was not a trust expense, and all the stuff that I paid for with that debit card, he's going to move that from a trust expense column over to the debit card column. So let's say at the end of the year, I had $80,000 of non-trust expenses that I use a trust debit card to pay for. Well, all he's going to do is subtract that 80,000 from my demand note, and that's not a taxable event, right? Because it's just return of capital. So that's how I'm able to live using this trust without having to really pay much in the way of taxes, because that's the genius of the system. And it's all legal.
What happens at the time of your passing, like with the trust? Like obviously, like if I had, and I don't even know the name of it, like a living trust, at the time of passing away, my kids get what's called the step up in basis, and then they can sell the properties if they want to. How is this different than that as it relates to estate taxes, inheritance tax, step ups in basis, etc.?
It's different in a few ways. It's similar in other ways. First of all, in my trust, I have 4 beneficiaries. I have my 2 adult children, my wife, and my grandson. My wife also has a designation called successor trustee. So if something happens to me, if I get incapacitated or I pass away, then she becomes the trustee. Now, we have a stipulation in our trust book that if she and I go together, hopefully not, if we do, then my daughter will become the successor trustee and she will continue. All of the wealth, all of the assets, everything that we've worked our entire lives to attain, that we want to
Hmm.
pass down to our kids and our grandkids, that's all inside our trust, and we want to keep it inside the trust. So what's going to happen when we go? All that's going to happen is that my daughter's going to take over as trustee, but the money coming in the trust is still coming in from our assets, right? And she's just going to continue the way we're doing right now. So there's no inheritance tax, no estate taxes, nothing like that at all.
And then if she wanted to sell some of the assets,
She could,
can she? She
sure.
could.
She's a trustee. Yes,
She can do whatever. Okay,
yes. Hmm.
cool. Do
Yep.
people get creative with the spendthrift trust? Meaning, like, I read something about like people using it for like divorce settlements or.
Yeah, I mean it's the ultimate prenuptial agreement. So my wife and I've already decided this. My son, when he gets before he gets married, we're getting him a trust, and then we can move something from our trust into his trust, whatever we want him to have. But when that happens, before he gets married, uh, they get divorced. She ain't getting anything because she'll be the trustee, but he's not. It's not communal property. It stays inside the trust, so she won't have anything. So you could do that theoretically. I mean, you're a pretty horrible person, I guess, if you do this. But I mean, theoretically, if you're married, I mean, I could screw my wife so bad if I wanted to, because all of our assets, everything's inside this trust. I'm the trustee. I have 100% control. If I want to say, "See you later, honey," I could remove her like that from the trust. I don't
So
want
if,
to.
if somebody was good, if somebody was thinking about getting divorced, they could actually create a spendthrift trust ahead of time, transfer all the assets there
No
with a
transfer.
husband and a
You
wife.
sell them. You sell them, and if it's communal
Okay.
property, it has to be sold into the trust for both of them. So it's not like you can get away scot free. If you decide to do that, you get divorced. And remember, with my wife, it was all communal property, so most of it. But let's say the trust owes her X amount of money, so the trust is going to have to pay her because there's a legal document that says the trust owes her half of whatever we sold her in the property. So she still gets access to that, but she can't get the properties. She can't get the income.
Yeah. What about costs? Like, is it like, do you have to make a certain amount of income or have to have like a certain amount of net worth in order for this to make sense? And then,
Yeah, I mean, I don't want to put a label on it because I have clients that, you know, I have one client that makes a little over 100,000 a year. He's an owner operator truck driver, but it makes a lot of sense for him because I mean, for him, he pays like 10, 12,000, $15,000 a year in taxes, and with this, he does not paying. He pays a tenth of that now. But most importantly, he sold his rig into the trust. The trust is leasing it back to his LLC. So he's saving a significant amount of money by the LLC paying him, I mean, paying the trust rent or lease for that rig. But more importantly, what if he gets into a catastrophic accident? What if he kills somebody? You know, I mean, think about that. That's the worst case scenario, but it happens a lot. If he doesn't have a trust, they're coming in and getting everything. They're going to get the insurance. They're going to come after him, come after his trust. They're going to take everything. But with the trust, that all his because he's going to sell. He sold all of his business assets into the trust, including the rig. They're untouchable now. All anyone can do is go after his insurance. That's it. He's protected. His family's protected. His business is protected. So for him, even though maybe the tax savings didn't make as much sense, on its own, but adding that kind of asset protection made a lot of sense.
so can you give us a couple of examples of different situation that business owners would benefit from this?
Okay, well that was one right there.
Yeah.
So
Uh huh.
all right, so I'll give you one with a real estate agent, or even a
Hmm.
1099. Well, let's say a real estate agent. Okay, so most agents they're paid a commission that's tied to their social security number. So
Correct.
what they can do is the same thing. The commissions are paid to them, and of course, all that's going to go down to their Schedule C in their tax return. So they're going to normally that's they're going to be taxed on that. But you can set up a business trust with this regular trust, a non-grantor trust that we do, Spendthrift Trust. And so that real estate agent can sign the trust can do a personal service or professional services agreement with her as a real estate agent. She keeps 95% of her commissions can now go over to the business trust, and she's going to run her business through that. She's going to run her she pay all her expenses and so on and so forth. And then her Spendthrift Trust is going to sign an limited partnership agreement with that business trust. So whatever's left over can move down as limited partnership profit sharing into her beneficial trust, which is not going to be, it's a passive income, so it won't be taxable for this trust. So by doing that, she's legally moving a huge amount of her money over to the trust. But it's as an expense. Listen, there's a the IRS has a concrete bedrock rule of the assignment of income that he or she or it, whoever earns the income, pays the taxes. Okay.
Mm-hmm.
And so when people hear this, they think, "Oh, you can't do that. You're violating the assignment of income doctrine." But it's not, because if she took that $95,000, let's say she had a commission for $100,000, she took $95,000 and moved it to the trust. That's taxed. You can't do that. They'll be taxed. Okay. But by doing it this way, all she's doing is adding additional expenses to her as an agent. A business can pay expenses, right? There's nothing wrong with that. People, a business can sell its assets into the trust, and the trust can lease those back. And the IRS will allow up to 70% of the business's net income to be used as a taxable, for a release payment, right? I mean, it varies. It goes up and down. It depends on your cash flow and so forth, but just in general, but that's the most you can get. So, businesses do lease-back strategies all the time. That's all we're doing. We're just adding additional expenses to a business that the business pays to the trust, but in a way that it's passive income for the trust. You see how that works?
Yeah.
Okay. So that's what I'm saying is that's one example. So another example, let's say that someone, a 1099 employee, let's say that does really well, or he or she does really well, makes $400,000 or $500,000 a year, and it's not salary, it's not W-2, but it's 1099. So in this situation, what they could do is have their clients pay them into an LLC, make the trust as much as a 90% limited member, multi-member LLC. They're controlling member, but they only have 10% maximum. Okay. And so what will happen is that 1099 person will sell, again, the assets of the LLC to the trust. The trust leases them back to the LLC, and then after the lease payments are paid by the trust, the LLC's income is going to go down drastically. But even whatever's left, up to 90% of that can go over to the trust as limited partnership profit sharing. So theoretically, if you got $1 million of net taxable income in an LLC, you could move as much as $970,000 that over to the trust through a lease-back strategy and limited partnership profit sharing.
I love it. That's awesome.
Mm-hmm.
Is there anything else that you think that would be helpful to our viewers as it relates to the Spendthrift Trust?
Yeah, I would just say a couple of things. The part of the tax code that makes this legal is IRS Code 643B, right? And so as someone that files taxes, my trust files taxes, I know how this works. And we have a network of accountants who specialize in doing 1041 tax returns for clients who have this specific trust. The most senior one has done this for 33 years. And he's done tens of thousands of trust tax returns in his career. Not one time has it ever been audited. Not once. Okay, when the trust was copyrighted in 2001, I believe, the IRS came and asked for a copy of the trust for them to examine. So they came to the office, the law firm's office, and they were given one, of course. They came back, I don't know, a few weeks later, and the agent said, "Yeah, you're good." And he left an opinion letter that said, "Yeah, this is 100% legal." Um, there is 50 plus years this has been out there, and so I hear a lot of people saying, "Well, it's too good to be true." It's like, well, yes and no. I mean,
Yeah.
it was the idea of being, Columbus going to China was too good to be true, but he made it to America. I mean, it's just because you don't have the knowledge doesn't mean it's too good to be true. Obviously, the knowledge is there, the experience is there, and this is, this part of the tax code has been there since it was first passed in the early 1900s. So
I
they
love it.
put it there. If it's there and you can use it,
And then you actually help clients set this up, right?
yes.
So if somebody wanted to get in contact with you to be able to set this up, or maybe somebody had a couple of questions about this, what would be the best way for them to do that?
I think the best way, I'm a very simple person. I operated my real estate investing business through my cell phone. And I've had the same phone number since 2002. And so, I've given my phone out to everybody. I don't even care about hiding anything. Take my phone number, okay? I would say send me a text. My number is 407-902-7827. Send me a text and say I want more information about the trust. I'd be glad to send it to you.
I love it. And then they could also follow you on social media, right?
Mm-hmm.
As well too, if they wanted to.
Yes,
Um,
I'm big on TikTok. You can find me at Ironclad Trust. All right. I'm on YouTube. Just go to my YouTube channel. It's Don, youtube.com/senior, SENIOR, trust specialist. Okay. I'm saying this is Don, the senior trust specialist. You can go find me. It's easy to find me on YouTube. Okay. I'm on Facebook, Instagram, LinkedIn. So yeah, just, you can find me.
I love it. Great. So I want to say thank you, Don, for obviously coming on the show. This is a topic that we've never covered on the show.
Mhm.
I think it's like a niche type of topic, but I think that there's people out there that can benefit
Yeah,
from something like this.
absolutely.
For me personally, any good books that you'd recommend on this that, like, if somebody wanted to learn more about it? Um,
It's interesting you said that because I'm actually in the process of publishing a book about it.
I love it. I
Yeah,
love it.
so I will definitely reach out to you, and you can get my book because it's coming out
Yeah.
real soon in May. We're gonna publish it in May.
I love it. You know, it's funny. I did an episode on self-directed IRAs, and the first time I did it, my eyes were just like glossy.
Mm-hmm.
And then I read a book on it, and now I feel like, okay, now I understand the topic a lot
Mm-hmm.
better.
Yes.
So whenever I have somebody on the show like you that comes in with a topic that maybe I'm not as familiar with, I always
Mm-hmm.
read a book on it, and then that helps me understand it fully. So yeah, I'd be excited about the book.
Yeah, I'll
And
definitely get you one when it comes out.
depending when it comes out, we may be able to link it to the podcast.
Great.
So
Perfect.
for our viewers out there, I just want to say thank you guys. Don, thank you so much for coming on. This was another episode of the Morales Group Show. Today we talked about Spendthrift Trust, non-grantor, irrevocable, complex, discretionary Spendthrift Trust. If you like this episode, make sure to hit the subscribe button. If you feel that this episode would be helpful to a friend, make sure to hit the share button. Thanks again, Don, and I look forward to doing another episode maybe on short sales with you.